One person invested $2,000 a year for 20 years and ended up with $124,000. Another person, same money, same market, same 2 decades, walked away with just $44,000. Same market, same 2 decades, same starting money. The difference wasn't intelligence, it wasn't luck, it wasn't timing. It was one boring strategy that almost nobody on Finance TikTok will tell you about because it doesn't sell courses. Let me show you exactly what it is. Here's the uncomfortable truth. The internet has convinced an entire generation that building wealth is about being clever, spotting the next Amazon, calling the top, buying the dip. It's a fantasy, and it's costing regular people hundreds of thousands of dollars. Because what a 20-year Charles Schwab study actually found is the exact opposite of what the gurus are selling. And by the end of this video, you'll know which of 5 investor types you are right now and which one you need to become. Quick note, this isn't financial advice. It's what 2 decades of real data say. Let's get into it. So, what is this so-called boring strategy? It's called dollar cost averaging, or DCA, and it's basically investing on autopilot. The concept is dead simple. You invest a fixed amount of money on a regular schedule, regardless of what the market is doing. It could be $50 every Monday, or $400 on the 15th of every month. The amount and the schedule are locked in, and you just let it run. You set it, and quite frankly, you forget it. When the market is soaring and prices are high, your fixed dollar amount naturally buys you fewer shares. But when the market plummets and prices are low, that same fixed amount automatically buys you more shares. Think of it like buying your favorite coffee. If the beans are expensive this month at $20 a bag, your $40 budget gets you 2 bags. If there's a big sale next month and they're only $10 a bag, your same $40 budget now gets you 4. Without even trying, you stocked up when the price was cheap. Over time, this automatically drives down your average cost per share. But the real power of DCA isn't just the math, it's psychological. It removes your 2 greatest enemies from the equation, fear and greed. You're not trying to second-guess the market. There's no agonizing over whether to invest today or wait for a better price tomorrow. The decision is already made, which forces you to build a disciplined, long-term habit. For anyone earning a regular income, it is one of the most accessible and least stressful ways to begin building wealth. Now, let's look at the other strategy, the one that sounds way more exciting, buying the dip. The idea is simple and incredibly tempting. You hoard your cash, waiting for the market to fall. When stocks go on sale, you rush in and buy low, positioning yourself for massive gains when the market recovers. It sounds like a genius move, the stuff of investing legends. But here's the trap that snares almost every beginner. What counts as a dip? A 5% drop? 10%? What happens if you invest during a 10% dip only to watch the market slide another 20%? That's known as catching a falling knife, and it's a painful experience. You deployed all your capital way too early and have nothing left for the real bargain. Conversely, what if you're waiting for that perfect 15% dip, but the market only falls 12% before it reverses course and rockets to new all-time highs? While you were sitting on the sidelines in cash, you just missed out on significant growth. History shows that the market spends far more time climbing than it does falling. Waiting for the perfect moment often means missing the journey altogether. Look, even seasoned professionals get it wrong constantly. Market timing is so incredibly difficult that it's practically impossible to do consistently. You have to be right twice. You have to know when to get out and when to get back in. For most of us, buying the dip isn't a strategy. It's just gambling with a better PR team. So here's the study that should be taught in every high school in America. Charles Schwab tracked 5 investors over 20 years, from 2001 to 2020. That window is important because it includes the dot-com crash, the 2008 financial crisis, and the COVID crash, 3 of the worst market events in modern history. Each investor got $2,000 every January for 20 years. Same money, same market, 5 completely different strategies. The results will mess with your head. Investor number 1, Chris Crystalball. Chris is not a real human being. Chris is a cheat code.
Every single year for 20 years, Chris invested his $2,000 on the exact day the market hit its lowest point. Perfect timing, every time. He's the unicorn every finance influencer pretends to be. Final portfolio, $138,000. Now keep that number in your head, $138,000, because what happens next is going to break your brain. Investor number 2, Chloe Commit. Chloe didn't try to time anything. The moment her $2,000 hit her account on January 1st, she invested it. Boom, done. No analysis, no waiting. Final portfolio, $127,500. Read that again. The person with literal godlike foresight beat the person who just invested immediately by about $500 a year. That's it. That's the payoff for 20 years of perfect timing. Investor number 3, David Disciplined. This is our guy. David is the dollar-cost averaging investor we've been talking about. He split his $2,000 into 12 equal monthly chunks and invested automatically, no matter what the market was doing. Final portfolio, $124,000. Now pay attention to this gap between the best possible human and the boring automated strategy. 14 grand over 20 years. That's less than 1% a year in difference. Investor number 4, Sarah Unlucky. Sarah is the anti-Chris. She has the worst luck in the universe. Every single year, she invested her $2,000 on the exact day the market peaked. The worst possible day, 20 years in a row. Guess what she ended up with? $121,000. The woman who bought at the worst moment every single year for 2 decades made $121,000. She beat almost every actively managed fund on the planet by being terrible. Which brings us to our final investor, and this is the one I want you to really pay attention to. William was smart, or at least he thought he was. William was the dip hunter. Every January, he'd get his $2,000 and decide, the market feels too high. I'll wait for a pullback. He kept his money in cash, earning almost nothing, always waiting for a better entry point that never quite felt right. Final portfolio, $44,130. Look at this chart. Look at it. The person with the absolute worst market timing in history still made nearly 3 times more money than the person who was being careful. This is the most important slide in all of personal finance, and nobody shows it to you. Waiting to invest didn't protect William's money. Waiting destroyed his future. So why is timing the markets so difficult, and why is DCA so effective? It all comes down to our primitive brains. We are simply not hardwired for investing. We are governed by 2 extremely powerful emotions, fear and greed. When the market is crashing, our every instinct screams, sell, get out, not, this is a great time to buy more. When the market is euphoric, FOMO, fear of missing out, takes over, and we're tempted to pile in right at the peak. This is why the legendary investor Warren Buffett has said for decades that for most people, the best move is to consistently buy a low-cost index fund and get on with their lives. In his 1993 shareholder letter, he stated that by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. He's essentially saying that trying to be a market timer is a loser's game for the majority of us. So how do you actually put this into practice? First, embrace automation. Set up recurring investments from your bank account directly into a low-cost index fund or ETF. This removes emotion and guesswork from the process entirely. Second, if you absolutely can't shake the urge to buy a dip, try the hybrid approach. Automate the core of your strategy. Let's say 90% of your capital investment goes into your DCA plan every month without fail. Then keep the other 10% in cash as your opportunity fund. You only deploy this cash during a massive, predefined market event, like a 20% crash. This lets you scratch that itch to be proactive during a downturn without derailing your main wealth-building engine. Finally, if you're still skeptical, just run a simulation. Use a free online stock market simulator. Try to be a market timer. Try to be a dip buyer. See for yourself how incredibly hard it is and how strangely calming a simple, automated DCA strategy feels in comparison. At the end of the day, remember this: your behavior is far more important than your brilliance. The lesson isn't that Chris won. The lesson is that Chris, Chloe, David, and even Sarah all ended up in roughly the same place because they were in the market. William wasn't. No amount of cleverness makes up for years of not being invested. Time in the market beats timing the market every single time. So tell me in the comments right now, today, are you a David, Chloe, Chris, or William? Be honest. Time in the market beat timing the market every single time. If this video helped clarify things for you, do me a favor and hit that like button and subscribe for more simple, data-driven investing content. And check out my next video on how to actually choose the right index funds for your financial journey. Thanks for watching, and I'll see you in the next one.